And today's topic is something we're really looking forward to talking to you guys about: mutual funds. So, yeah. Drum roll, please. Let all the excitement go. Throw some confetti up in the air.
Make it rain.
Yes.
No, I'm just kidding.
So, what exactly is a mutual fund and how does it work? So, we were talking before we went on air to tape this segment to really tell you about a few key definitions so that you would understand how mutual funds work, how they can be a part of your investment portfolio, and how they differ from some other types of funds that you might have heard about. So first off, a mutual fund is basically a basket of securities. It's a way for you to diversify and to get professional money management over a set of assets. So just like you've heard the expression, don't put all your eggs in one basket, you don't want to have just one specific stock or two or three that you're buying and holding, especially if you're going to be a long-term investor. Well, a mutual fund is going to let you have 50, 100, perhaps a couple of hundred stocks that are in one individual fund. And those stocks have been pre-selected and picked by a professional money manager.
Yeah.
So,
I was going to say, one of the big assets or advantages of one of the biggest advantages of a mutual fund is the fact that it's actively managed. So for many people that feel like, I don't know anything about the stock market, I don't know anything about investing, that's why you may want to lean towards a mutual fund, because it is managed by professionals. They choose the companies, and then they'll be looking at how they perform. Many of you guys also will have these in your retirement account. So that's one of the reasons why we were so excited to talk to you about it, because your 401k or your retirement probably is investing in mutual funds, and now you can know what they are.
Right, exactly. And so why does some of this stuff matter to you? Well, it matters because a mutual fund can give you a low-cost way to access the markets, first and foremost. Imagine if you had to try to buy 100 different companies or shares in 100 different companies all by yourself. You might be spending, I don't know how many.
A lot of money.
Yeah, a lot of money, tens of thousands or hundreds of thousands of dollars. But that's not necessary. When you buy via the mutual fund structure, it's kind of all wrapped together, and you're getting incremental or partial shares of each one of those companies. So not only are you getting diversification, that's one good benefit. Not only are you getting professional money management, that's another benefit. And as Teri mentioned, you don't have to worry about it or think about it or spend a lot of time researching it because the experts have done it for you. But you also get this structure that makes it kind of easy for you to get started and do so in a low-cost way. A lot of mutual fund companies will let you get started with $500, $1,000. Some will let you even invest smaller increments as long as you do it consistently month after month. So these are some of the reasons why mutual funds matter and why they make sense for a lot of retail or individual investors.
Yes, and as we talk about pricing, one of the big differences about a mutual fund is that its price only changes once a day. So at the end of the day, then after the market closes, you'll see the price of the mutual fund change.
Right.
That's different from stocks. Stocks, and we also hear people talk about exchange traded funds, ETFs. They change price throughout the day. As volatility and liquidity goes, they move, and you can trade in and out of them. Y'all know I like that because I'm a trader. But a mutual fund, it only changes price once a day.
They're going to calculate the net asset value at the end of the day. And as she said, that's only at the end of the day. With an ETF, though, as she mentioned, of course, it's going to trade on an exchange just like a stock. So you could trade an ETF throughout the course of the day, but you cannot trade a mutual fund throughout the course of a day. So that's a key difference.
And it wouldn't make sense if the mutual fund was $100 to get in. In an hour, it's still going to be $100. So why would you need to trade it?
Right. Another difference, though, in terms of mutual funds versus ETFs is tax efficiency. So a lot of people like the fact that ETFs are deemed to be far more tax efficient because essentially with a mutual fund, you're going to get paid out capital gains taxes on that, regardless of whether or not you sell at the end of the year. Yeah. And so you'll get a tax bill that you have to deal with. With an ETF, that tax bill only comes into play when you actually sell. Yeah. So when you realize something, a gain and or a loss. So in general, ETFs are thought to be more tax efficient than traditional mutual funds.
Yeah, and when we talk about our 2 cents in a minute, that's one of the things that's interesting to me. You won't have control over the distributions from the mutual fund. So whenever they distribute to you, you will be taxed on that, because as soon as you receive money, that you have to pay the tax bill. But like Lynnette said, if you hold on to those shares, then you determine when you're going to actually take that gain, that profit or loss.
Right. So now, as we kind of give you our 2 cents about mutual funds, I think it's important that we distinguish between 2 primary categories of mutual funds. So we've told you that you can get professional money management, and that's absolutely the case. But there's actually another sort of subcategory or another class of mutual funds that you should know about, which are index funds. So what we've been talking about by and large are actively managed funds, where there's a professional money manager who's picked the securities that go into that mutual fund. And of course, you're paying for that, right? There's fees associated with having that professional expertise. Well, there's also a way that you can have a lower cost way to access the mutual fund environment through index funds. And index funds are passively managed funds where they're tracking a specific index. They might be looking at the Dow and tracking the 30 stocks that are in the Dow. They might be following the S&P 500 and tracking those 500 securities that make up the S&P 500, or perhaps even the NASDAQ, which is a more tech-heavy index, and they might be tracking the 100 stocks in the NASDAQ 100, for example.
And we're covering the indexes in another video, so make sure you check that one out to fully understand all the indexes. But the cool thing about these funds is, like Lynnette says, because the index funds are just tracking what the index does, they don't have to be as actively managed. It's more passive management because they're just tracking like one for one.
Right.
Versus in the mutual funds, they're trying to think like, is this one still going to be a good investment?
Right.
Let me
they're
take
doing a lot
out.
Of research. You know, analysts are going out there kind of kicking the tires, checking out companies. They're putting in a lot of legwork to do analytical work and to see like, should this even still be in our portfolio? Whereas with a passive fund, really, they're just making a decision saying which 500 securities are still in the S&P 500. Those are the ones we're buying, okay? So they make it a lot easier. So as a result, your cost structure, the fees that you're going to pay, the expense ratios is what they're called, are so much lower with passively managed index funds. And so part of our 2 cents, or at least my 2 cents, is that I actually think that index funds are a great way to get into the mutual fund environment because they're lower cost in terms of the structure. And frankly, those commissions and fees, sometimes it might seem like a little bit, oh, it's just like 1%, or it's like, you know, a half of a point, something like that. But you know what? Over time, if you're going to be a long-term investor, all of those additional commissions and fees eat away at your portfolio's performance. It drains your account, okay?
Yeah.
So you want to have the lowest possible cost structure when you're investing in mutual funds, and that's through index funds.
Yep, and speaking of fees, we forgot to mention that in mutual funds, sometimes you can get a fee for exiting your position early.
Absolutely.
So say you got into this, one of the people who invest, we don't want to put out a whole bunch of people, but one of the popular investors might be like a Vanguard mutual fund. Maybe you got into that fund and then they said, okay, you have to be in here at least this much time. What's a normal time frame for being in a mutual fund?
I don't know. They all have a different one. They all have a different,
so like say they say, well, you can't get out less than 6 months. and you decide, you know what, I actually want to change up my portfolio and I want to get into something new, and it's 3 months out, you might have to have a fee for that.
Right.
So
and
that's
we're not saying this is
fee.
for all Vanguard
Sorry,
funds.
not for them, but just because some people might be like, let us understand who you're talking about.
Right.
But anyway, just if you're in a mutual fund, they may have a dedicated amount of time you have to be in it to not have a fee.
Right. So some of you might be thinking about, okay, well, how can I get started? How can I buy some mutual funds, either an actively managed fund?
Wait, before we say how we get started,
yes.
Can I give my 2 cents too?
Absolutely.
So if you were to ask me, like, Teri, do you think you should get into a mutual fund? And actually, you might have some more on this too.
Okay.
But I think, like I was telling Lynnette off camera, I'm like, right now, it just doesn't make sense to me. Because, like, the fees are higher, you can't control it. With an ETF, at least you can control it. If you were in an index fund, then you also have a bit more advantage. So for me, I was like, I don't understand why I would do it. But then I thought about it. If you're in your retirement, you have to choose mutual funds. They usually don't give you any other options because the companies like to have their portfolios actively managed. So you're going to only have like a limited number of companies to choose from anyway. So I can't tell you don't invest in it. Like, you are already invested in your retirement in mutual funds. And then if you get a wealth manager, oftentimes they also refer you to mutual funds. So when you talk to your wealth manager, he or she is going to give you a list of funds to choose from. So in that sense, I would say if I'm personally trading, I would want to trade maybe an index ETF, exchange traded fund following the index, if I just wanted more of like a pool of stocks at the same time. But if you got to have mutual funds, then it's best that you know about them.
Like QQQ, NASDAQ 100, that's
ETF.
Yeah, and that's an ETF as an example. We mentioned, Teri mentioned Vanguard, and we were saying, okay, it's not just them. You know, a whole host of companies, all the investment firms out there that you can think of, you know, whether it's Schwab or E-Trade or Fidelity or Vanguard or Nuveen or, you know, take your pick, they all offer mutual funds in a variety of ways. And so, again, some of them have professionally, actively managed funds. Some of them are going to offer you index funds. So it's definitely up to you to kind of do some homework around that. Do your research and make sure that you understand the cost structure that's associated with buying any type of fund, whether that's an ETF, whether that's an actively managed mutual fund, or whether that's a lower cost, generally, a passive, you know, index fund.
And look, and look at their rate of return too.
Performance matters.
Yeah, as you're deciding, is this the one that I want in my portfolio? They usually, because they're actively managed, they have to do a lot of reporting. So there should be some reports that say, like, the last 5 years, this is how the fund did, or even last year, this is how the fund did. And if they're not doing well, feel free to mix that up and pick a different one.
And guess what? There's been a lot of research that shows that basically over time, index funds that are, you know, passively managed tend to actually outperform actively managed funds. Yeah. And so you might think that a lot of, you know, Wall Street analysts and economists and folks who are advisors who live, breathe, eat, and sleep this stuff all day long, you're like, okay, this is Wall Street's best and brightest. You know, they know what they're doing. They're picking the best stocks to go into these mutual funds. Not always. You know, stuff goes wrong and the markets do what they do. They go crazy sometime and not according to expectations.
And I'm sorry, I didn't mean to interrupt you.
No, you're good.
And oftentimes when you are picking your allocation, so you get a new job and they say, okay, Teri, what do you want to put in your retirement towards? I've noticed that many of the same companies that offer a mutual fund will offer an index fund too.
As an alternative.
So it's something that, and I'm not going to say always because I don't know that, but check to see if your company will allow you to invest in index funds in your retirement and not just mutual.
That's absolutely the case. So there you guys have it. This has been our explanation for those of you watching, and we hope that you continue to like and subscribe and watch us here and on all other social platforms that you might be viewing. But we hope that this has given you a really good grounding in the basics of mutual funds, what they are and how they work. Love you guys, and we'll see you in the next session.
Love you. Put in the chat if you learned something new today.
Let us know. Hit us up.